What is going on, investors? Hopefully you guys had a great weekend. Time to kick things off this week when we talk about Palantir Technologies, ticker symbol PLTR. This company just reported earnings this morning, and it is not going well. The stock is down 10% today during the regular session. It will probably bounce around as we watch this video. When we jump over to the stock chart, we'll take a look at where this one is heading. Maybe there's some areas where we can come in here and buy. Maybe you're a dip buyer. Maybe you're looking to go long this stock. We'll talk about that here in a minute. Now, let's jump into the earnings. It was a bad one from a loss perspective. So they swung to a pretty large Q4 loss. We'll see evidence of that when we jump over here to the stock chart, and investors are pretty much rejecting this. Now, they had some pretty large contracts, including Rio Tinto. PG&E was a big one. I heard that one on CNBC when that one was announced. BP, U.S. Army, U.S. Air Force, FDA. They have a lot of contracts, not just with the government, but with, kind of public companies as well. So things are rolling. When we get over here to the revenues, here's our statements of operations here. We've got 3 months ended here, 19 over 20. We've got our year end here, 19 over 20. It was a fantastic quarter from a revenue growth perspective. Notice that we went from about $230 million of revenue all the way up to $322 million worth of revenue. Now, here's what I thought was really impressive. Here's our cost of revenue right here. We spent $75 million in the previous year. We spent even less. So we bolted on about $100 million worth of revenue, and we spent even less to get that revenue. That is fantastic. That led to a gross profit of $251 million off of $322 million worth of revenue. That is fantastic in my opinion. Now, for the full year, doesn't paint as glorious a picture, but not that bad either. It was really a great quarter. See, they went from 742 up to $1 billion in the year, and revenue. Gross profit came in at $740 million. This is what I would call an extraordinarily high margin business, at least from the gross profit perspective. You see, last year they grossed out about $500 million. So nice growth, both on the top line and the kind of the gross profit line, especially in this quarter. This is a fantastic quarter. Now, not the full story. We've got sales and marketing, research and development, and general administrative expenses. And as you can see in the most recent quarter, those grew fairly significantly. We went from $300 million in expenses last year up to $408 million. Okay. Now, when you gross out $251 million and then you spend another $408 million, guess what happens? You lose $156 million from operating. Now, that's up a little bit from last year, where we lost about $147 million from operations. I'll talk about more about this in a minute. There's a little bit of stock-based compensation baked into these numbers, something that you want to think about. Now, for the full year, similar story plays out. In fact, I think it gets even a little bit worse when you look at the full year. We see here we lost $576 million last year when we spent about $1 billion on operations. This year, we lost $1.17 billion when we spent about $1.9 billion running the business. So pretty bad in terms of operating loss, but from a gross profit perspective, it's pretty nice. Now, here's some things that a professional investor would kind of want to factor in. Stock-based compensation. Notice down here in cost of revenue, this is included stock-based compensation as follows. We'll also see evidence of this when we jump over to the cash flows as well. So in the cost of revenue, it's about 19 million of this 70 is actually stock-based compensation. Sales and marketing, 75 million of the 147. So over half of this cost is actually stock-based compensation. In research and development, 47 million of 94 million is actually stock-based compensation. And finally, in general administrative, about 100 million out of 166 million is stock-based compensation. Now, at Palantir, they can't pay their employees with napkins or golf clubs or something like that. Okay, they actually have to pay them with something. So you can take this all with a grain of salt. The employees are gladly, or at least some of them, or most of them are gladly accepting shares of the company in lieu of, more payment or more dollars. So we'll see if they're able to continue that going forward. But just keep in mind, this loss from operation isn't necessarily all cash. We'll see more evidence of that when we're in the cash flow segment in a minute. So cash and cash equivalents, plenty of cash. We got about $2 billion, got a little bit of restricted cash, got some accounts receivable, everything looking solid from this end. Obviously, our current assets ticked up by about $1 billion really on this cash line. Everything else looks pretty nice. Now we've got a little bit of debt here, but it actually went down and everything looks pretty good. Our total liabilities went from $1.4 billion down to $1.17 billion. So a really like liability light company, one that can be nimble. Obviously they kind of recently gone public. They haven't been a public company for that long. We see here maybe back into last year. And stock's had an incredible run. I mean, it was a $9, $10 stock, and now it's at 20. So if you've been in this one for a while, today's drop is not that big of a deal. Now, here we go. Cash flows. Last thing that I want to show you before we get over to the stock chart. We'll check out if you can buy this one on the dip. We've got year ended here, 19/20. We see our net loss here. We pull that number down at $1.1 billion. Last year, we're at 579. Here's our big, gigantic stock-based compensation line. Okay, last year, we were at 241, probably because they weren't public for most of the year or at all. This year, whenever you go public, you tend to really start spreading. It's like, going to the club and spraying the dollar bills out. That's what tends to happen when a company goes public. They just start spraying the shares out and start giving everybody shares of the company. They distributed $1.2 billion worth of stock-based compensation. I want to show you something. For the full year, they did $1.09 billion in revenue. $1.09 billion in revenue, and in stock-based compensation, they did $1.2 billion. So they gave out more stock than they did actually sell products. So obviously this is not something that can repeat itself. We see net cash used in operating activities. This will give you a good idea once you strip out stock-based compensation, how they're doing from a cash perspective. They burned through $165 million last year, about $300 million this year. My guess is, remember when we looked at the balance sheet, they got about $2 billion worth of cash. I would guess next year they're probably going to burn through some cash as well. So they're probably either going to they'll probably do a following offering. They'll probably raise some more money in the share market. We'll see what they end up doing. With that, we do see, principal payments on borrowing, issuance of debt here, issuance of common stock. Obviously, the big one, you raise up $942 million by issuing that stock. Exercise of stock options down here as well. So they're doing a lot on this side. My guess is in 2021, you're probably going to see a similar thing because they're probably still going to burn through some cash. They're going to give out quite a bit of stock in terms of stock-based compensation. They have cash on the balance sheet. It's pretty liability late company, but it is one that's probably going to need to raise some more money. Just something that you want to keep in mind. Now, the stock is down pretty big today, about 10%, and it is falling into a level of consolidation that appeared really just a few months ago. I'm on a different trading platform right now because my regular one just wasn't loading this morning. Anywhere between about $24 and right where the stock is sitting right now at about $29 is an area of consolidation. I'd like to get it down here probably in the middle of this range. So you're looking right around $27, $26, $27 in my opinion would be not that bad because this was a pretty large area of consolidation. $29 though should act as a pretty significant area of support. And we're seeing that today right here. The stock is just resting right here on this level where it was resistance here. It was not hard resistance here, but it was some resistance here as well. So if we fall into this box, I think the lower end of the range is right around $24 to $23, somewhere in that range. If this one pulls back to that range, I like this. Whether or not you want to add to your shares or you want to swing trade this one, I don't mind that at all. I think this one is setting up. It's one I'm going to put on my watch list. I think we've got a nice little setup here. So Palantir Technologies down. Now we're saying it's bouncing around a little bit. Now we're down about 8%, but keep an eye on this one. It is a well-followed stock. It's one I get asked about a lot here on the channel. So hopefully you guys enjoyed this video. Back again soon. Good luck with your investments.